Hello everyone, Mehdi for Tokyo Alpha Mind. So today, 5 questions that every investor has to ask himself, and why mastering this question is going to make you very successful in the investing game. So let's get started. Investing is actually a lot of nuance and being able to understand very complex and different situations. And so there are a lot of questions that you are going to ask yourself repeatedly during your investing journey, and we are here to actually review them and to give you some hints how to enter them and how to manage your portfolio by yourself. The first question that actually popped up on X, and that is actually one of the biggest questions that a lot of investors have, is should you sell your winners? And that's actually a very tough question to answer, because the right answer is actually it depends. There are a lot of examples where you should have sold your winners, and a lot of examples where you should have not sold your winners. And I think a lot of investors, especially very successful ones, are going to tell you that no, you should not sell your winners. We have seen a lot of examples of people selling Amazon, selling Nvidia, selling Apple, and missing huge runs going forward. And so definitely, if you have a very good company, I also think that this is not a good idea to sell a great company which is continuing to win. You should be aware of that. You should actually understand the company itself, but also the environment of the company and the tailwinds that the company has, and that going forward that the company is still not wildly overvalued and that it's going to continue to overperform the market going forward. And being in the market to time in the market beats timing the market. We have heard this phrase again and again, but this is actually quite true. So if you are in a winning name like Nvidia, for example, or like Google, Amazon, I think it's much better to just keep a portion of your portfolio within the name and to let it ride actually as long as it has good fundamentals, not wildly overvalued, and continue to grow. And we have other examples of companies which actually usually, which are hype companies, which actually get very overvalued very quickly. Those, I think, are names that you should definitely sell when they are becoming a little bit overvalued. And we have seen a lot of examples of such companies. I don't know, like for example, Celsius, for example, is a very good example. Wait at top at almost $100, and now we are seeing it at $30. There are countless of examples. We have seen that in 2021. We have seen that, and we are seeing that today. So like in the market. So just be careful in those, I would say, smaller names, which are actually lower quality companies and with like lesser brands. Because Nvidia, actually, the thing is that everybody knows about Nvidia, but not everybody knows about Celsius or companies like Wish, for example, which was a very big trap, I think, at the time. What you have to remember is that here you have to apply nuance, because the answer to your question, should you sell your winners, is not going to be all the time the right and the same answer. So just be careful, apply so your own judgment, and that's where you're going to become a better investors, because you have to understand that sometimes the odds are not in your favor and that the company can retrace significantly. One reason why you should not sell your winners, though, and I think this is a big warning to all of you, is for macro concerns. So if you have a great company which is winning, but you have macro concern, this is never a good idea to actually sell this type of great quality company because of macro concern. And something that we have seen in a lot of different investors, and which has actually been repeated by YouTubers like Joseph Carlson, for example. We have seen, like in the previous years, that the winners, they keep winning usually, and that's a better idea to actually stay in the market and stay in those winners, especially if they are great companies, not widely overvalued. So another question we hear all the time, and especially now that the market is at all-time high, is that should I invest at all-time highs? And so the data is actually showing you that yes, if you invest in a diversified index fund or ETF, especially in the S&P 500 or the Nasdaq, for example, it is actually for the long term a good idea to actually invest even at all-time highs. Why? Because the market actually trends higher over time. And so on the long term, I think this is a good idea to basically stay invested and to have time in the market rather to try to time the market. It may have worked for some time, but it's very hard to actually sell to buy back lower. I think many have tried. It's almost impossible because you have to be right twice. You have to be right on the way up, meaning that you have to get basically at the top, and you have to buy back at the bottom. And this is very hard because especially at the bottom, things are coming up very quickly. And when they're coming up through pessimism, meaning, or I would say through uncertainty. So meaning that it's very difficult to buy back stocks which are going up, even though there are a lot of uncertainty and a lot of risk of going back lower. So the best idea in this case, especially at all-time highs, is just to remain invested in great quality companies and to stay in the market. So maybe you have to be a bit more defensive. That's another discussion. But the thing is that trying to time the market and get in and out, as well as trying to time the timing of a potential collapse, I think it's not a good strategy. So invest at all-time highs. I think that yes, you have to invest your money, but just do it wisely. Another question we are actually hearing a lot is, am I late? Am I late in this name that had a huge run-up? So the answer is going to depend, because it depends on the stock, obviously. But I would say that as a general principle, you should not chase stocks. You always have, or you will always have, pullbacks to re-enter in a great name that you have identified. So never chase the hype, never try to FOMO into a stock. I think this is not worth it. But you will have pullbacks to try to get back into the name that you have missed. The only thing is that you may not get back at the level you could have get in previously, and you have to accept that as an investor. I think this is maybe one of the most difficult things as an investor, to try to remove this anchoring with the price, meaning that if you have missed an entry point at some levels and you think that the company is actually a great buy, being a quality company, fairly valued, and that is going to continue to grow going forward, just wait for a pullback, knows maybe the technicals of where are the support levels for the stocks, because all the stocks, they always pull back. This, you have to remember that they always pull back, and you will always have an opportunity to get back into the stock at a lower price, just not at the price you were hoping to enter at the beginning. So as an investor, you have to take that on yourself, and you have to accept this reality. And this is how you will grow as an investor, because you have to take into account the facts that are presented to you at the current moment and not what happened in the past. A question that I've been asked a lot actually is, should I concentrate more on my conviction? I think like here also we have to apply nuance. Why? Because I think first that yes, you should concentrate more into your biggest conviction. Why? Because if you want some return in the market, you cannot diversify away into hundreds of companies, especially if you have single stock portfolio. So definitely, if you have huge conviction in some stocks and that you think that they are going to overperform going forward, you have to concentrate. You have to have your biggest ideas with the biggest allocation in your portfolio. Having said that, what does it mean to have a big allocation in your portfolio? I think that a reasonable number for a big position in your portfolio is between 10 and 20%. Beyond that, I think that this is overexposure to a single ID. So this is definitely not recommended. We have seen a lot of successful investors going 50% into one name, but if you want to remain rational and reasonable, you have to understand that your level of conviction may be high, and that in order to get higher returns, you have to concentrate. That's a fact. But that's usually not a great idea. Even though a lot of people have made a lot of money in stocks like Tesla or Palantir by being almost all in, as an investor, is going to actually bring you down at some point. So except if you are the lucky ones winning the lottery with this type of ID, you should be reasonable. I think that 20-25% in one single ID is still okay. So you should concentrate in your highest conviction. Is going to work. And even like if you have 20% in a name that is going to 10x, you will still have great returns, and you will limit like huge downside if it doesn't work out. And especially if you come at, I would say, in the middle of a run for those type of stocks. So be careful in the market, never over concentrate. I think that this is a big lesson that a lot of investors have learned in their different years, even though some are going to say you or are going to tell you that this is how you win in the market. But definitely, as a reasonable investor, you have to understand that you have to restrain yourself and try to find other ideas that may be as good as the one you already have. Another very interesting question that a lot of investors have is, should I be more aggressive? And usually the answer to this question is no. No, why? Because if you ask the question, it means that you have some kind of fear of missing out, some kind of FOMO. And this is very dangerous if you are investors, and the best investors, even like Druckenmiller, they have been burned by this type of, I would say, fear of missing out. So definitely be careful. If you think that you should be more aggressive, especially depending on your personality, you should be careful, and you should think like, do I really have the proper level of risk in my portfolio? And usually, like, you can actually perform at a very high level without having to take more risk. You have to find opportunities which have lower downside but still have a lot of upside potential if your thesis play out. So you should be selective in the type of stocks that you have in your portfolio, the type, I would say, of investments you have in your portfolio, and not try to be more aggressive, especially going into higher beta stocks or like hype stocks, for example, trying to ride some trends, or even trying to have some more risky option plays. You just need to find more asymmetric investment in your portfolio. I think this is how you're going to win. I see how you're going to become a better investor, because you may win, but you may lose. And it's very hard to actually recover from huge losses in your portfolio. So please be careful once again and try to be reasonable. So the last question for today is actually a question that a lot of investors have when they underperform their index and when they underperform the market is, should I do stocks investing or should I just do index and passive investing? I think that to this question is very personal, but I really think that a lot of investors would benefit to do both, meaning having some part of your net worth into passive investing to just have, I would say, a safety net, something to rely on and to benefit passively from the growth of the economy in the US, or I would say globally. And on the other side, depending on your experience, your level of risk, and your appetite, I would say, to manage your own portfolio, you should actually have your own stocks and different, I would say, financial securities portfolio. And so that's why the answer to this question is still very personal, and this is not financial advice, so you should actually research and do your own diligence and decide by yourself. But I think that a lot of investors would benefit to have both as part of their own net worth. So I think that may be not the answer that you want for this question, but the idea is that you still have to be rational, level-headed, and you still have to consider a lot of risk in the market. And actually having some passive investment is going to give you maybe more open mind and maybe more, I would say, safety to invest in a single stock portfolio. So that was a few questions that every investor has actually asked him or herself during their career investing, and that I think that all of you are going to have going forward. And so I think that mastering these questions and your personal answer to this question is going to make you a much better investor and going to bring you the right psychology into your investing game and into your portfolio. And if you're interested into other analysis and investing wisdom, so please check my other videos on this channel and please subscribe, and I will see you in another one. Bye.